Chapter 2: Investors and Inflation. In this chapter, Graham explains how the accusations of most Wall Street investors about the impact of inflation on their investments are false. In this chapter, Graham also discusses in detail whether there is a link between the rate of inflation and corporate profits. We start with the idea that inflation is something that exists only to eat away at our wealth. Inflation comes slowly and eats away every cent of every dollar we have. However, we often forget this evil of inflation because of what psychologists call the money illusion. Simply put, the money illusion can be described as a phenomenon whereby we feel happier if we get a 2% increase in income in a period when inflation is 4%, rather than a 2% decrease in income in a period when inflation is 0%. We tend to only want to see the nominal absolute numbers increase, when in reality they are decreasing due to invisible things like inflation, rather than the loss that is clearly visible in the nominal numbers we earn. With this in mind, people are thinking of ways to overcome this persistent inflation problem. One of the ways that everyone has thought of is to offset the value of inflation with the rate of return that can be achieved through investment. Many Wall Street investors believe that equities are the only thing that can protect them from inflation. Stocks promise to compensate for inflation in the form of share price increases and dividends. But in this case, as with most things that are standard on Wall Street, the standard is not quite right. Graham explains that even high-quality stocks are not necessarily better in all circumstances, and that bonds can be safer than any stock. Two things are certain about inflation. Firstly, we have historical data showing that inflation does not consistently affect company stocks. Secondly, past inflationary conditions may be repeated in the future, and no one can determine how much inflation will occur. Therefore, for the investor was to decide whether it is better to hold mainly bonds rather than shares or vice versa in order to fight inflation. The judgment lies in the relationship with what is likely to happen in the future in the long term, and in the relationship with what will happen to the investor in the short and medium term. The state of mind, the hopes and fears, the satisfaction and dissatisfaction with what he has done, and especially all the decisions about what the investor is going to do in the future, are not determined in retrospect over a lifetime of investing, but are determined by his experience from year to year. So at this point, says Graham, we can be confident that there is no strong temporal relationship between inflationary conditions and movements in the earnings and prices of common stocks. As for whether inflation can benefit companies by increasing their earnings power, Graham's answer is a resounding no. Graham explained that, according to the data he presented, instead of benefiting companies and shareholders, inflation has the opposite effect. It is good for a smart investor to always consider the future uncertainty factor in investing. One of these future uncertainties is inflation, so that investors do not simply invest by putting all their assets in one investment instrument. Is there any certainty that the equity component will provide adequate protection against large-scale inflation? The answer is no. However, stocks tend to offer better protection than the bond component. In the next installment, we will delve into Chapter 3, which covers a century of stock market history.